While the retail market spent the last quarter chasing temporary spikes in meme coins and social media hype, a massive shift occurred in the architectural foundations of the crypto economy. For years, the narrative surrounding Hedera Hashgraph was one of quiet corporate utility, a network often dismissed by speculative traders for its lack of volatility or aggressive marketing. But as of early 2026, the data has finally stripped away the veil, revealing a reality that few were prepared to acknowledge. The recent Santiment report on real-world asset (RWA) development has sent a shockwave through the industry. In a sector projected to manage trillions in liquidity, Hedera has officially claimed the throne, ranking as the #1 blockchain by verified GitHub development activity. Now this is not just a minor victory, it is a displacement of the industry's most entranced giants. For the first time, Hedera has outpaced both Chainlink and Avalanche in raw engineering momentum. Hedera now leads the RWA sector in engineering output, surpassing both Chainlink and Avalanche in monthly activity. To the average observer, GitHub commits might seem like an abstract metric, but in the world of institutional finance, they are the only honest signal. While prices can be manipulated by liquidations and sentiment, you cannot fake thousands of hours of high-level code deployment. Now, this surge in verified development actions indicates that Hedera is outpacing the industry in engineering innovation and long-term infrastructure growth. Our latest tracking of notable GitHub events reveals a distinctive flip in the RWA sector. Hedera's development frequency has surged significantly, indicating that the building phase for institutional tokenization is no longer speculative. It is active and it is accelerating. This observation, it forces us to confront an unspoken truth. The market is currently mispricing the most active engineering hub in the space. And while competitors are frequently discussed in headlines, Hedera has been operating as an invisible giant, constructing the trust layer for global commerce in the shadows. The engineering gap is widening, and as the data shows, the distance between Hedera and its closest rivals is becoming undeniable. The transition from a corporate experiment to a dominant force in RWA development is now documented fact. We are no longer looking at a potential competitor. We are looking at the new yardstick for the RWA era. The engineering dominance suggests that the infrastructure for the next decade of finance isn't being built where the noise is the loudest, but it is where the code is the most consistent. To understand why Hedera's ascent to the top of the Santiment rankings is a structural shift rather than a temporary fluke, we have to look past the marketing departments. Now, in the world of high-stakes technology, there is a fundamental law. Capital follows talent, but institutional trust follows the code. Now, the engineering arms race is the quiet struggle happening behind the scenes, where networks might fight for the one resource that cannot be subsidized or faked, that is sustained developer attention. Now, in the crypto sector, retail participants often confuse activity with volume. They look at the exchange data, the social media mentions, or the number of new tokens launched in a single week. However, institutional architects, they are looking at the GitHub repositories. They view it as the heartbeat of the network. If the heartbeat stops or slows, well, the network is considered a ghost chain, regardless of its market cap. Hedera's current trajectory suggests a heartbeat that is accelerating while others are flatlining. Hedera's development trajectory has disconnected from the industry's average, signaling a focused push towards full-scale institutional readiness. This surge in GitHub commits represents more than just fixing a few bugs. It signifies the development of the new features, the hardening of security protocols, and the expansion of the Hedera Token Service, HTS. When we see a spike in development actions during a period of relative price stagnation or low price activity, it actually reveals a profound disconnect between the value that is being built and the price being traded. Now, developers are not building in a vacuum here. They are building towards specific requirements set by the governing council members and external partners who demand enterprise-grade performance. GitHub activity is the lead indicator of network longevity, and while marketing campaigns can buy a month of attention, a consistent upward trend in development events indicates that the core infrastructure is being prepared for a massive influx of real-world traffic. The revelation here is that Hedera is winning the war of attrition. And while other chains are forced to pivot their narratives to stay relevant, Hedera has stayed the course, focusing on the dull but essential work of infrastructure. This engineering momentum is a defensive moat. It ensures that when a global bank or a massive logistics firm looks for a partner to tokenize billions in assets, well, they'll find a network that has been battle-tested through thousands of code updates. Now, we are witnessing the preparation of the pipes before the water is actually turned on. The engineering data suggests that the water, the actual trillions in RWA value, is much closer than the market currently anticipates. The biggest criticism leveled against the crypto industry over the last decade has been the lack of grandma-proof utility. For years, blockchain technology kind of felt like a closed loop, a system built by developers for developers with no clear path into the hands of everyday consumers. However, the partnership between Stripe and MINGO on the Hedera network has quietly solved this great divide. This integration is the practical application of the engineering dominance that we discussed in the previous chapters. It represents a shift from abstract code to a multi-trillion-dollar real-world utility. See, Stripe is the undisputed king of Web 2 payments, processing billions in volume for the world's largest companies. MINGO is a platform designed to fix the broken state of the global ticketing industry. By combining these two with Hedera's trust layer, they have created a system where a user can buy a ticket with a credit card, standard Web 2 behavior, while the actual ticket is minted and secured as an NFT on the Hedera ledger. Now, the consumer, they never actually need to know anything about the blockchain, or even that they are using it. They simply benefit from the fact that their ticket cannot be faked or unfairly scalped. This integration enables Hedera-powered ticket verification and Stripe payments to function across 47+ countries, targeting a global event fraud. This is the holy grail of mass utility. It removes the friction of onboarding by allowing users to interact with the network through the payment tools that they already trust. And while other networks are trying to force users to learn about seed phrases and gas fees, Hedera is moving into the background. It is becoming the invisible plumbing of the digital economy. And when you buy a ticket for an event like Comic-Con on Ireland, or maybe a major sporting match via MINGO, Hedera handles the logic, ownership records, and transfer rules in real time. Our system isn't just about tickets. It's about delivering experiences while adding value for the organizers. By connecting ticket data on Hedera, we can eliminate tampered records and control resale rules at a global scale. The unspoken truth here is that Hedera is the only network capable of handling this volume with the necessary cost certainty. Because fees are pegged to the US dollar but are paid in HBAR, event organizers can predict their costs months in advance, something that's impossible on networks where gas fees spike during high demand. Now, this stability is why Stripe, a major company that demands 99.9% reliability, is able to function alongside MINGO on this infrastructure. Now, we are seeing the gap between high-level engineering and practical mass-market utility disappear in real time. When we look at the chart-topping development activity and the high-profile integrations with companies like Stripe, it is easy to get swept up in the narrative of inevitable success. However, as an investigative look requires us to kind of peer into the shadows as well, the risk of the unseen is the friction between the technical excellence and the market reality. See, in the crypto space, there is often a massive lag, sometimes years, between a project achieving a technical milestone and those milestones reflecting in the asset's price. Now, we have to be honest with ourselves here. While the Santiment data puts Hedera at the top of the leaderboard for RWA development, the market is a chaotic machine driven by emotion just as much as logic. This is probably the best time for me to take a quick step back and to be real with you. I'm sharing this data because the engineering momentum is undeniable, but please remember that I am a documentarian, not a financial advisor. Now, investing in any crypto asset, including HBAR, carries significant risk. The unspoken truth also includes the fact that the high development activity does not guarantee price appreciation. We are dealing with a frontier market where regulatory shifts, macroeconomic collapses, or even a simple shift in retail sentiment can wipe out gains in an instant. So never put in more than you can afford to lose, because even the best tech can fail if the market timing is off. Now, despite being number one in RWA development, Hedera's price remains 85% below its all-time high, highlighting the disconnect. The risk isn't in the price, it is in the timeline. The MINGO and Stripe integration is a massive win, but mass adoption takes years to move the needle on network fees and coin velocity. Many investors enter this space expecting immediate returns because of a partnership headline, only to be shaken out when the reality of a long-term corporate cycle sets in. The primary risk for enterprise-grade chains is that the adoption lag. While the code is ready for trillions in volume, the legal and regulatory frameworks for institutions to move those assets on-chain are still being written. This is the tension that we must navigate. On one hand, we have the most active development hub in the RWA sector. On the other, we have a retail market that is often blind to these metrics, preferring the immediate dopamine hit of speculative assets. Understanding the gap is crucial. It is the difference between being a holder and being an informed participant who understands the shocks to the market usually happen slowly and then all at once. The global ticketing industry is currently a mess of middlemen markups, duplicate barcodes, and predatory scalping. While the total market for online event ticketing is projected to exceed $53 billion this year, a staggering percentage of that value is siphoned away by bad actors. For the average consumer, buying a ticket for a sold-out concert or a major sporting event feels like a gamble. This is precisely where the ticketing revolution on Hedera moves from theory into high-stakes practice. MINGO's integration of Hedera Hashgraph isn't just a technical upgrade, it is a structural fix for a broken system. By utilizing the Hedera Token Service (HTS), every ticket is minted as a unique programmable NFT. This allows event organizers to embed rules directly into the ticket's code. For instance, an organizer can set a maximum resale price or ensure that a percentage of every kind of secondary sale flows back to the venue or even the artist. This effectively neuters the incentive for scalpers to hoard tickets and flip them for a 500% markup. Sources of fraud in the $50 billion ticketing market highlight why on-chain verification has become a necessity for major event organizers. The cost of this security is the second half of the equation. On legacy blockchains like Ethereum, the fee to mint or transfer a ticket can fluctuate wildly, sometimes costing more than the ticket itself. Hedera's fixed fee model, where minting an NFT will cost you a flat 5 cents, provides the cost certainty required by partners like the World Boxing Council, the WBC, and 𝗗𝗶𝘀𝗰𝗀 Island, right? These organizations, they cannot wait for low gas windows to issue thousands of tickets. They need a system that works at the speed of a credit card swipe. Our NFT-based system isn't just about tickets. It is about delivering unforgettable experiences to fans while adding value for organizers. By eliminating fraud and protecting fans, we are setting a new standard for how the digital economy interacts with live events. The revelation here is that the unspoken truth of mass adoption isn't found in a flashy DeFi protocol, but in solving the invisible pain points of the real world. When MINGO uses Hedera as the verification layer, they are essentially using the network as a digital notary that can process tens of thousands of transactions for the price of a cup of coffee. And as the model scales across the 47+ countries supported by the Stripe integration, the sheer volume of the boring but essential transactions will create a floor of utility that few other networks can match. Now, we are seeing the end of the Wild West of ticketing era, and it's being replaced by a ledger that can never forget who owns what. While the average retail trader evaluates a blockchain based on its potential for a pump, institutional architects use a much more rigorous filter. Be for a global bank or a sovereign entity, the primary concern is not the speed. Right? It is the identity and reliability of the people running the infrastructure. And this is where Hedera's governing council model acts as a unique institutional filter that most other networks simply cannot pass. You see, on most public ledgers, nodes are run by anonymous people or entities. But for a regulated bank, this is a non-starter because they cannot risk transacting on a network where a node might be operated by a sanctioned individual. Now, the Hedera Council, now featuring over 30 world-class organizations, including Google, IBM, and more recently, energy giant Repsol, and financial leaders like Lloyds Banking Group, it solves this problem. Each node is operated by a known, reputable entity with a multi-billion-dollar reputation at stake. This structure provides the compliance shield that allows institutions to build at scale without the fear of regulatory blowback or underlying network instability. So when Lloyds and Aberdeen choose Hedera for the UK's first tokenized FX trades as collateral, they weren't just choosing a technology. They were choosing a governance model that they could present to their regulators. Hedera's governance diversity across 11 different industries provides a level of cross-sector stability that specialized or anonymous networks lack. This level of structural security is precisely why we spend so much time analyzing the nuances of these council actions. It is a complex landscape to navigate, which is why we track these specific institutional metrics and council meeting minutes inside our free Discord server. We use that space to keep everyone up to date on the latest crypto developments and how these silent corporate moves eventually manifest as network utility. Now, if you want to stay informed as these institutional pieces fall into place, then you can join our community through the link that is in the description. One of the most appealing things about Hedera is that the network nodes are run by the council. You don't have anonymous or, even worse, potentially sanctioned individuals running nodes and earning fees off of your transactions. This is a critical requirement for enterprise-grade applications. The unspoken truth here is that Hedera has traded away the Wild West narrative of total anonymity for something far more valuable in the longer run: institutional permission. By creating a system where the validators are household names, Hedera has cleared the path for quadrillions in legacy assets to eventually migrate on-chain. Now, this isn't just about decentralization by the number of nodes. It is about decentralization by industry, geography, and legal standing. As the engineering arms race continues, the Council acts as the ultimate filter, ensuring that only the most resilient and compliant infrastructure survives the coming regulatory era. The real-world asset RWA market isn't just a single industry. It is actually a global collective of debt, equity, and real estate, currently locked in inadequate, slow-moving systems. Now, when we speak about the trillion-dollar pipeline, now we are referencing the literal transition of these legacy silos onto a 24/7 digital ledger. Now, on Hedera, this isn't a planned roadmap. It is a live production environment. Two specific entities, Red Swan and Archax, are currently serving as the gatekeepers of this massive influx of capital. Red Swan, a commercial real estate marketplace led by former Cushman and Wakefield executives, has already leveraged Hedera to tokenize over $5 billion in institutional-grade properties. By fractionalizing high-value assets like the hotel on Riverton in New York, they have actually transformed what was once an illiquid million-dollar entry point asset into a tradable digital security. For the very first time, an investor in Dubai or London can own a fractional piece of a Manhattan skyscraper with the same ease as buying a stock, all secured by Hedera's immutable records. You see, institutional capital flowing into Hedera's RWA pipeline is accelerating, with projections reaching $25 billion in tokenized real estate by 2027. While Red Swan handles the bricks and the mortar, Archax is handling the money. The Archax is the UK's first FCA-regulated digital asset exchange. Recently, it's launched its pool token functionality on Hedera. Now, this allows the creation of on-chain portfolios, creating money market funds from the world's largest asset managers, including BlackRock, State Street, and Legal & General. Now, these aren't speculative crypto funds. These are the core engines of global finance, now transacting as native tokens on the Hedera network. By enabling the creation of pool tokens on Hedera, we are eliminating the operational inefficiencies that have long plagued traditional investment structures, all while maintaining regulatory compliance and institutional-grade security. You see, the unspoken truth of this pipeline is its inevitability. You see, when institutions like Lloyds Banking Group and Aberdeen use these tokenized assets as collateral for multi-billion-dollar FX trades, they are proving that Hedera is no longer a testnet for the curious. It is a settlement layer for the world's most demanding financial players. The pipeline is open, the plumbing is verified, and the volume is starting to move from millions into billions. We are now witnessing the birth of a secondary market that never sleeps, while a billion-dollar property or a sovereign bond can be traded on a Tuesday at 3 AM with instant finality. There is a psychological phenomenon in the crypto markets known as the hype utility gap. Now, while institutional architects are focused on 10-year infrastructure plays, the average retail participant is often distracted by the immediate dopamine of price action. And as we enter early 2026, this disconnect has created a massive retail blind spot regarding Hedera. You see, while Santiment data confirms that Hedera is the #1 network for RWA engineering, the price of HBAR has remained in a consolidation phase, trading significantly below its psychological barriers. Now, to most retail traders, a lack of green candles is interpreted as a lack of progress. They see meme coins or high-emission layer 1s pumping on social media hype and assume that those networks are winning. But the unspoken truth is that institutional adoption doesn't start with a price pump. It starts with a value moat. Hedera is currently building the widest moat in the industry by securing the world's most significant financial rails, from Stripe's global payment infrastructure to BlackRock's tokenized money market funds via Archax. While retail sentiment remains neutral with a fear and greed index of 42, Hedera's actual network utility has grown by 500% over the last 12 months. This is where education becomes the most valuable asset that you can own. Most people lose money because they chase the shouted truth on Twitter rather than the unspoken truth found in the actual data. And this is exactly why we launched 𝗗𝗶𝘀𝗰𝗀.com. And if you are looking to move past the noise and actually understand how to evaluate these metrics, then we do have free courses available to get you started. And for those who are ready to dive into the professional grade analysis, then you can get a 50% off of our paid courses using the code that you'll find in the description. Retail follows price. Institutions follow utility. The danger for the individual investor is ignoring a network that is winning every technical metric simply because it hasn't had its retail moment yet. By the time the price reflects the utility, the asymmetric opportunity is usually gone. The revelation of the blind spot is that the market is currently a voting machine in the short term, but it will inevitably become the weighing machine in the long term. Now, as billions of dollars in real estate and money market funds transition from pilot programs to full production, the weight of the Hedera network will become impossible for retail market to ignore. The question is whether you are going to be watching the scoreboards or the players. But while the scoreboard shows a quiet price, the players, the Googles, the IBMs, the Stripes of the world, are playing a game that retail hasn't even realized has started. As we move deeper into 2026, the global crypto landscape is undergoing a massive structural shift. The era of regulatory uncertainty is being replaced by a hard-coded reality. The markets in crypto assets, MiCA regulations, have officially moved from paper to practice across the European Union. For many networks, this is a moment of crisis. They have to scramble to kind of rectify their protocols for compliance. For Hedera, though, it is a moment of validation. By design, the Hedera Council has spent years building a regulatory fortress, a network architecture that treats compliance not as an obstacle, but as a feature for institutional survival. Now, this fortress is built on 3 pillars: identity, accountability, and fixed costs. Because the network nodes are operated by some of the most highly regulated companies on Earth, such as Standard Bank and Deutsche Telekom, the protocol inherently aligns with international sanctions laws and anti-money laundering standards. Now, this is the compliance shield that most anonymous networks lack. When a major financial institution looks for a venue to issue a asset referenced token, ART, under the MiCA framework, they aren't looking for a permissionless vacuum. They are looking for a jurisdiction where rules are clear and validators are known entities. You see, MiCA compliance deadlines across the EU have created a hard boundary for crypto services, favoring networks with institutional governance models. Now, navigating this new regulatory world is difficult for the average investor, as exchanges and services are forced to obtain formal authorization or cease operations. Knowing where your assets are safe has become more important than the assets themselves. This is why I have compiled a list of trusted crypto exchanges and related bonuses on my website, which is linked in the description down below. So if you are looking for a platform that have survived this regulatory filter and offered the best security for your HBAR holdings, then that should be your first stop. By mid-2026, authorization is no longer a choice in the EU market. It is the price of admission. Networks that cannot provide transparent audit logs and clear governance will find themselves isolated from the world's largest regulated financial markets. The unspoken truth of 2026 is that the Wild West of crypto is over. The networks that will thrive are those that can bridge the gap between the decentralization of code and the reality of law. Hedera's integration of the ERC-3643 token standard into the Asset Tokenization Studio is the final proof of this. It allows for global compliant cross-border asset issuance where the rulebook is programmed directly into the token. Now, we are moving from a world where you hope a trade is legal to a world where the ledger simply won't let you make an illegal one. Now, the regulatory moat is the final piece of the puzzle that ensures Hedera's dominance in this $1 trillion RWA cycle. Now, we have arrived at the final layer of our investigation, where the data and the narrative finally converge into a singular, undeniable reality. After analysing the engineering search, the institutional filtering process, and the practical utility of the global partnerships like Stripe and MINGO, we must face the ultimate revelation. The unspoken truth is that Hedera Hashgraph is no longer merely competing for a spot in the crypto top 10. It is quietly positioning itself to become the default ledger for the entire real-world asset RWA sector. While the broader market remains fixated on price volatility and social media sentiment, the foundational value moat of the network has reached a critical mass that makes its future dominance look more like a mathematical certainty than a speculative bet. Now, the Santiment data placing Hedera at the #1 spot for RWA development serves as the smoking gun in this investigation. It proves that the engineering talent in this space is no longer evenly distributed across dozens of hopeful protocols. Instead, it is clustered around the only network that offers fixed costs, a compliant-first governance model, and the technical finality required for global finance. You see, Hedera's dominance in RWA development events, it suggests a coming shift in total value locked as institutional products move to the main net. This concentration of talent is the lead indicator of where the money will flow next. The revelation is that we are witnessing a silent flip. In previous cycles, leadership was defined by retail hype and the number of active wallets chasing the latest trend. But in this cycle, leadership is being defined by infrastructure readiness, and Hedera has already won the engineering arms race, and the transition of assets from the trillion-dollar pipeline is now simply a matter of timing and legal paperwork, not technical possibility. The shock that the market felt at the start of 2026 was the sudden realization that the boring corporate chain had systematically outbuilt the exciting speculative ones while nobody was paying attention. The market eventually reflects reality when the world's most regulated companies choose a single network for their most valuable assets. The truth becomes undeniable. By the time that the average retail trader recognizes this shift, the most significant institutional rails, from BlackRock's money market funds to global event ticketing, will already be settled on-chain. Hedera is the invisible winner of the RWA cycle because it has chosen to focus on the plumbing while everyone else was focused on the paint. And as we look towards the remainder of 2026, the disconnect between HBAR's technical dominance and its market valuation represents one of the most significant asymmetries, right? In the digital asset space, the data is clear, the code is being written, the council is expanding, and the utility is being used by millions of people who don't even know that they are interacting with a blockchain. This is how a new financial standard is born, not with a shout, but with a series of quiet, unstoppable code commits, and that changed the entire world from the inside out. Now, you can do me a favor by hitting that like button, subscribing to the channel, and checking the video that is queued up on the screen. I will catch you all in the next one.